Great to have you here today, Joe. It's just going to keep going higher. What do you say? What's going to happen here?
Oh, I think we're just getting started. I think we will see national average prices sometime between July and August of $5.50 on retail gasoline nationwide and $6 in diesel. I mean, I think the points I'd like to make today are Jamie Dimon was correct. There is a hurricane coming. That this eye of that hurricane is energy. And there's really very little we can do about it now, except Washington's trying to look like they're concerned and doing something, but the die is cast. We're using about 18 million barrels to 19 million barrels a day, which is slightly down. There is some rationing going on, at least in the gasoline market. Not significant rationing, but over time, as people change their habits, there will be. But, and the other point I would make is it takes a while for the real effect of energy prices to get passed down the chain. So I think inflation is not going to get better. It's going to get worse. And inevitably, we will have a recession. I mean, you can't take $730 billion out of the U.S. economy over this year for energy in a $20 trillion economy, which is almost 4%. And given the history of almost every energy spike was followed by a mild or severe recession, is just inevitable.
So when you say that, Joe, let me just interrupt for just a second, if I might. You say that there's going to be $730 billion coming out of the 20 trillion. You're talking there about the excess money or the increment of money that will be spent this year on energy by American consumers, correct?
Yes, Tyler. Incrementally, $730 billion.
$730 billion, and add to that whatever the Fed takes out.
That's heating oil. That's all the components made from petroleum, like pharmaceuticals, rubber, plastics.
And to that point, I think you couldn't be more correct. I think it takes a long time for the effect of rising oil and petroleum and distillates and so forth to move through, because it touches so many parts of the economy. So let me ask you, let's say we buy your thesis here. What are you doing? You run now a large chain of convenience stores, and I assume some of them are associated with gas stations. What are you doing to prepare for the scenario that you see? Are you not hiring anymore? Are you laying people off? What are you doing?
Oh, no, our business has never been better. I mean, the consumer continues to drive, which is one of the factors behind this. We are hedging, and we are trying to create long-term contracts that will give us supply and also increasing our supply points, because you never know who's going to run out of oil or which refineries.
And what are you doing with prices? What are you doing with prices? Not in terms of gasoline sales, which are kind of baked into the cake, but let's talk about the cakes and the drinks and the other things you might sell at a convenience store. Are you passing along higher prices?
Somewhat, but we try to hold our prices as best we can, but the consumer really does understand and is accepting slightly higher prices without a drop-off in demand.
Yeah. All right, Joe, thank you so much for your insight today. We were very grateful to you.